Hi guys, it's Stock Curry, and the Black Friday results for 2022 are in, and the stock market crash of 2022 has resumed. In today's video, I will explain why the record-breaking Black Friday was actually bad, so let's get into it! Stock market futures are selling off despite a record-breaking Black Friday. On Thanksgiving Day, on Thursday, online shoppers spent a record $5.29 billion, which was an increase of 2.9% year over year. Now, that sounds like a great thing, but you have to understand that in prior years, this number has gone up by anywhere from 10 to 14% year over year. So even though 2.9% did represent a record year for Thanksgiving Day shopping, this was actually a significant decrease in growth from prior years. Now, on Black Friday itself, sales were at $9.12 billion, which was again a 2.3% year over year increase. Now, record-breaking sales sounds like a great thing. You would think the stock market would rise significantly, but it's selling off. And here's why. Even though online Black Friday sales were up 2.3% year over year, inflation this year has run over 8%. So actually, once you subtract out inflation, this means that online sales were actually down year over year. And another major concern is that buy now, pay later payments increased by 78% compared to the last week, meaning consumers actually can't afford to buy Christmas presents, and they are struggling with high prices and inflation. That means consumer debt will continue to rise, which will put more downward pressure on the U.S. economy next year as people have to pay off all of this debt that they're getting into. Now, there were some other shocking results from Black Friday, so let's talk about this one. Walmart overtook Amazon as the #1 place where shoppers were finding Black Friday deals. Even though Amazon was #1 last year, they didn't just fall to second behind Walmart, they fell all the way down to 4th place. Searches for Black Friday discounts on Walmart surged 386% year over year. Meanwhile, Amazon ranked 4th behind Target and Kohl's respectively. This is not good news for Amazon, and it points to some significant issues with Amazon being able to maintain growth. They've already seen a number of quarters of declining growth, and this will continue to be bad for Amazon. I would not be surprised to see Amazon share price continue to fall over the next few weeks and quarters. Digging more into the Black Friday numbers, the National Retail Federation says it expects holiday sales during November and December to rise between 6 and 8% from last year, which is still a decline when factoring in the effect of inflation. Overall, expectations for Black Friday shopping this year were extremely low, and early signs show the season may not be as gloomy as predicted. Online sales climbed 2.9% year over year. That's slightly better than the estimates for growth during the overall holiday season. So the overall Black Friday numbers were a record high amount of sales, but once you factor in inflation, Black Friday shopping actually declined this year, which is not a good sign. It means people are buying fewer and fewer products. Further, there was a lot more money put onto credit cards and buy now, pay later payment plans, meaning consumers just do not have the money to shop this Black Friday. And it looks like they're going to continue to spend anyway. And as they do, it is really going to set consumers up for a really bad position going into January and February and March of next year, as they then have to pay off all of the money that they're spending right now that they can't afford to spend. And that could further help trigger this recession that everybody is expecting in 2023. Now, here in the United States, we definitely have our problems, but I got to tell you, our problems are nothing compared to what's going on in China. Shanghai is now being hit by massive protests as anger spreads across China. Many of Shanghai's 4 million residents have been under some of China's longest lockdowns, barred from leaving their home for as long as 100 days. Now, China is trying to get things reopened slowly, but clearly people have reached the end of their rope, and these protests have actually shut down certain factories in Shanghai, including some factories that Apple uses to produce their phones. So this could have more negative impact on anybody that does business in China, including Apple and Tesla. And further, oil prices face fresh volatility with new Russia sanctions and an OPEC decision coming up. OPEC and its allies are due to make a big call on oil production this week, a day before expanded sanctions are set to strike Russia's energy industry. The potential impact of these moves is helping shroud the oil market in uncertainty at a time when coronavirus outbreaks are hammering demand in China. Mr. Haig expects Russia will struggle to divert all of the oil that the European Union bans, leading to a drop in daily production of 1.5 million barrels in 2023. That will contribute to a jump in the global oil prices next year if China demand bounces back. Russia has said it would refuse to abide by the cap, and its response is another wild card. Now, oil prices have been dropping consistently for the past few months. However, it looks like we might be nearing a bottom in the sell-off in oil, and we could be facing a rebound in oil prices here shortly. Now, in the stock market, stocks have been rising quite a bit over the past few months, going on a massive rally due to expectations that the Fed is going to slow down the rate of rate increases. However, there is now speculation that the stock market might be topping out and might be getting ready for another downturn. Stocks are on the rise, but earnings could drag them down. This summer, analysts thought S&P 500 companies' fourth quarter earnings would rise. Now they think earnings will fall. U.S. stocks mounted a turnaround lately amid expectations that the Federal Reserve could slow the pace of its rate increases as soon as December. Investors say recent optimism in the markets could soon evaporate as corporate profits get squeezed further. If the earnings side of the equation pulls back, that could make the market look overpriced. Over 95% of S&P 500 companies have already reported earnings, but what we're really talking about here are forward earnings expectations, those earnings for Q4 and Q1 of next year. Wall Street analysts have sharply marked down current quarter earnings estimates for S&P 500 companies, and they are now projecting the first annualized quarterly earnings decline since 2020. Analysts still paint a rosy picture going forward, though, with consensus forecasts calling for a more than 5% annualized earnings growth for calendar year 2023. But many investors anticipate further downward revisions as the potential recession looms and the Fed's rate increases make their way into companies' bottom lines. Don't forget that as the Fed raises interest rates, it takes anywhere from 6 months to a year for the impact of those interest rate rises to hit the U.S. economy. And we are just now starting to see the impact of those interest rate rises. Keep in mind, the Federal Reserve continued to raise rates over the past 6 months, which means we should see a continued downward in the economy as well as company earnings for at least the next 6 months. And that is what is causing investors to think that analysts will revise their forward earnings expectations downward. Keep in mind that a lot of large market investors, especially pension funds and some large investment banks, will trade based upon analyst expectations and not the current market environment. The stock market is forward looking, and as analysts continue to revise their expectations for the future downward, that is going to cause the forward-looking market to also sell off stocks in anticipation of earnings going down over the next 6 months. Now, we also have some major economic news coming out this week, including Jerome Powell speaking, and we have some economic and labor market reports. On Tuesday, the S&P Case-Shiller National Home Price Index will get released, and this is for the September home prices. Now, home prices fell 1.1% in August, and we're going to wait to see just how much home prices fell in September. The Conference Board also publishes its November Consumer Confidence Index, and this is something that the Federal Reserve looks closely at to determine how much to raise interest rates by. So we're really going to have to see how consumer confidence looked in November. Now, Wednesday is the biggest day for economic news. The Labor Department releases their October data on job openings, quits, hires, and layoffs. Keep in mind that September had a surprise increase in job openings, mostly on the retail side, probably retailers getting ready to hire for Black Friday and the holiday shopping season. So we'll have to see how the October jobs data does. Now, on top of that, we also have Federal Reserve Chairman Jerome Powell giving remarks on the U.S. economy and the labor market on Wednesday. And believe me, when Jerome Powell speaks, the stock market moves. Wednesday could be a big mover in the stock market. Now, on Thursday and Friday, we do get some weekly jobs numbers, but the big economic news coming out on Thursday is the fact that the Consumer Department will be releasing figures on U.S. household spending and income in October. This report will also include the PCE, or Personal Consumption Expenditures Price Index, which is what the Fed uses to measure inflation. In September, the PCE rose 5.1%, which was the highest increase since March. Wages will also be an important thing to look at on Thursday so that we can get a better understanding if a wage price spiral is starting to take effect or not. But really, it's that PCE that's really going to move the markets on Thursday. I hope this video helped you out. If you got a lot out of it, share this video with your friends and family so that they will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you want more market news and want to understand some stocks that you can buy in order to take advantage of this market opportunity, make sure you watch the last video that I uploaded here.